A warm welcome to all of you to this live session at Wide-Moat Investing Summit 2017. It gives me great pleasure to welcome back to this forum David Barr and Felix Narhi. They are with Pender Fund Capital Management. David is President and CEO of Pender. He's also the portfolio manager of several of Pender's funds. For example, the Pender Small Cap Opportunities Fund, which Dave manages, won a Lipper Fund Award in 2015 and 2016 for Best Canadian Small Mid-Cap Equity Fund over both 3- and 5-year performance periods. Felix serves as Chief Investment Officer and Portfolio Manager of Pender. He serves, for example, as PM of the Pender U.S. All Cap Equity Fund and the Pender Strategic Growth and Income Fund. Those of you who've been with us in the past will appreciate the ideas as well as the depth of research that Dave and Felix have shared with us in the past. We always come away learning something and having interesting ideas to follow up on following their presentation, and I very much look forward to Dave and Felix's remarks today. Please feel free to type your questions into the online interface at any time, and we will get to them during the Q&A session. For now, I'd like to turn it over to you, Dave and Felix. Please go ahead.
Thank you, John. Thanks, everyone, for joining us. Just quick intro for those of you who are not familiar with Pender. We're West Coast, Vancouver, employee-owned investment management boutique. We offer, we focus on small, nimble funds, and we employ a concentrated value-based approach. And our PMs are highly invested in the funds they manage, and I think that's just consistent with the types of funds that can outperform. They're not the massive funds, the smaller pool of capital, employing a concentrated value approach where the manager's aligned. And our goal, we want to create value for our shareholders or investors through focusing on the downside first and preserving capital and letting the economics of the business and the margin of safety we buy stocks that drive the value of the portfolio longer over a period of time. With that, I think I'll switch it over to Felix to talk about our first idea here today.
Great, thanks, Dave. Since this is a Wide-Moat investment conference, I just thought that we'd chat about initially kind of how we view moats. And really there's kind of two buckets of moats, we think. So I think the traditional definition certainly is taught by Warren Buffett is the moat is the moat around the castle that protects highly profitable businesses, established businesses typically. But we also think that more emerging moats are very interesting. So when you think about a lot of the wealth that's being created out there historically, for example at Walmart or Starbucks, they created their most amount of shareholder value before you could really put a finger on how wide their moat was. So it was basically in the process of becoming wider. It was an emerging moat. And once it's truly wide and large, often the value creation process slows down a bit. So we look for a lot of emerging moats because we think that's where a lot of compounding can occur. Secondly, when you think about technology and all the disruption happening today, increasingly, large legacy moats are being disrupted. So there's this concept that Charlie Munger talked about from a number of years ago called surfing, where basically if you're sort of the early surfer, basically you catch the initial wave of, when the basis of competition changes and you catch the wave, you can get a really, really long runway of compounding value. So we're kind of on the outlook of basically emerging moats that haven't really been identified yet that have long runways. With that being said, we mentioned that technological disruption and competitive destruction is a bigger force than we've seen in a long, long time, and frankly, we think these forces favor the so-called surfers. So if you think about kind of traditional moats, on the left, Borders, Blockbuster, Kodak, Columbia, 20, 30 years ago, Kodak probably had the largest moat that you could even think about. I mean, they're almost impenetrable. And what's happened, of course, recently is that anything that can be digitized has increasingly been taken away, so that they've destroyed those moats. So basically, the basis of competition has changed, and the legacy moat owners often are not quick enough to adopt to these changes. So a huge amount of wealth has been created for the successful surfers. So when you think about sort of, where future value comes from, we're really at the early stages of this digitization process. So, Mark Andreessen, co-founder of Andreessen Horowitz, famously said 6 years ago that software is eating the world. So essentially, the value is being moved, is becoming digitized, and the value creation is basically digital. And sort of the next inflection point we think is, here today, which is artificial intelligence. And Jensen Huang, who's the founder of NVIDIA, last month said that software is eating the world, but AI is going to eat software. So, when you think about, where tomorrow's value is going to come from, we think it's really important to pay attention to some of these secular waves that are happening right now. So one of the analogies that, people talk about between artificial intelligence is sort of the back half of the chessboard. And one of the problems that, people have is that we really have a hard time conceptualizing exponential growth. So the story of the chessboard helps to kind of put that into context. So the inventor of chess showed the king his invention. The king was so impressed with it that he said, name me your own prize for inventing this. And the inventor said, well, I'd like to have 1 grain of rice for the first square, 2 grains of rice for the second square, 4, and sort of doubling and so on with each square. And the king thought this was a rather modest request, and started to give the rice to the inventor. At first it was by the spoonfuls, then by the cupfuls, then by the barrelfuls, and by the time you finish the first half of the chessboard, you've essentially given 1 large rice field worth of rice to the inventor. And that's still kind of easy to conceptualize. We kind of get that that's a large rice field, but you can kind of understand that. It's the back half of the chessboard where things get kind of crazy. So by the time you reach the last square of the chessboard, the 64th square, you would have had to give the inventor of chess the equivalent of rice fields that covered the entire Earth all the way over twice, including oceans. So, that's an unimaginable amount of rice, way more than humankind has ever made, a magnitude of. And it's really hard to conceptualize that much rice, which is why the king basically granted this wish to the inventor of chess. And we think that basically, AI is entering the back half of the chessboard, and things that are going to happen in the next 2, 3, 5, 10 years are going to be mind-boggling and very impactful for a lot of businesses. And that brings us to our first idea, which is Baidu. Probably most of the listeners here know something about Baidu. They are a leading Chinese tech firm, #1 in search, online video, and AI. Co-founded in 2000 by Robin Li, who's still the CEO, and went public on the NASDAQ in 2005. So why do we like Baidu? Well, there's a massive opportunity in China. We really like founder-led companies, and certainly Baidu is founder-led. There's a very deep moat in their core business search. They have a number of other interesting businesses which are non-core that provide lots of optionality. And then this concept of surfing, which we think is just beginning. We think Baidu has a good chance of surfing AI for a long period of time. And of course, all this is wonderful, but if it's not available at a sensible price, then what's the point of investing? So that is the thesis. The macro opportunity is massive in China. There's over 700 million online users. To put that in context, it's more than twice the population of the United States, and the penetration level is slightly past halfway there. And the amount of time people spend online, similar to many corners of the earth, is more and more. So you have more penetration potential and you have more usage online. So again, a great macro opportunity. When you look at the competitive landscape, there's essentially 3 companies that control most of the online business and usership in China. The so-called BAT, Baidu, Alibaba, and Tencent. Collectively, the 3 control more than 60% of the online ad spend in China, and their properties represent more than 70% of the time spent in China. So simply, it is an oligopoly in China, and the global peers, Google, Facebooks of the world, they're essentially restricted or blocked by the Chinese government. So they really keep them at bay and are able to create these huge regional local giants because the competition is just different in China compared to most other markets. I mentioned earlier that we really like founder-run firms. We like firms where the management team has a lot of skin in the game, and perhaps even more importantly, or just as importantly, soul in the game. You know, if you take a look at the big fortunes that are created, they tend to be made by missionaries versus mercenaries, and missionaries really have a lot of soul in the game. And empirically, if you take a look at the amount of shareholder wealth driven by founder-run firms over the long term, it tends to be a magnitude higher than non-founder-run firms. So it's a terrific thing that Robin Lee is leading this firm, and he's still relatively young at 48. I mentioned that Baidu has a defensible moat. Again, very similar to Google's search business. A few years back, Charlie Munger actually said that Google's got the largest moat he's ever seen, or widest moat he's ever seen. Certainly as the search leader in China, they've got more than 80% market share in desktop and mobile internet, so massive scale advantages. They've got the network effect because they've got the users, which attracts more content and more advertisers, so it's this kind of virtual feedback loop that's very positive. Perhaps most importantly, when you think about AI, is they have this massive, hard-to-replicate proprietary data set they've accumulated over the last decade or so. A great reputation as one of the oligopoly and a trusted brand in China. And last but not least, government backing. Very, very important and tangible moat. So slicing and dicing Baidu's business, they do have established moats and emerging moats. So in the core business, certainly that would be an established moat. I mean, it accounts for more than 3/4 of the reported revenue. It's a maturing cash cow. It spits off cash, and this cash has largely been used to fund other interesting opportunities that could be emerging moats. So they've got other businesses like ITE, which is the #1 online video service in China. They've got transaction services, which I'll get into later. Two other businesses that don't show up in this pie chart is Ctrip. So essentially, Baidu owns 20% of Ctrip, which is the #1 Chinese online travel agency, similar to Priceline and Expedia. And of course, artificial intelligence really doesn't show up in this pie chart, but these are all very interesting businesses, but are not yet established. So when you look at Baidu's core business, what can you say? It is an absolutely wonderful business. So you see the chart on the left, you can see that revenue and profits from 10 years ago have increased dramatically. So this is certainly when their moat was emerging as well. Hyper-growth stage. Currently that business generates close to $4 billion in pre-tax profits. And if you take a look at the amount of capital that's required to have in that business, it's essentially negative. So if you gave out all the net cash as dividends, and if you spun out their long-term investments like that stake in Ctrip, they essentially have negative capital funding that high-growth business. So when you think about the history of capitalism and how companies develop, this is highly unusual. And in fact, it's not just Baidu, Google, Facebook. A lot of these giants simply don't need capital anymore, and yet they can sustain very high growth because the basis of competition is no longer capital. It's other intangible moats. Of course, even great businesses can hit a road bump occasionally, and that's certainly the case with Baidu. Mid last year, there was a reputational hit for the company. A student with cancer was searching for a treatment and found a fraudulent treatment using Baidu's search engine, and there was a huge uproar in China. Medical customers have been greatly reduced as a result of this. The government tightened their ad rules. But we have seen this before. In 2008, they actually had a similar incident also with medical customers. And although the hit was pretty severe initially, ultimately it recovered, and it was a great time to buy the stock. Currently, the core search business is sort of in a stabilizing phase, and management essentially is hinting that growth is going to resume again second half of this year. Switching gears a bit, looking at the emerging moats in online, this is absolutely a huge, magnificent business. Not quite profitable yet, but very interesting. You can see the table on the left that shows the top online video subscribers. So these are paying subscribers, similar to Netflix. So at the end of last year, ITE basically had 45 million paying subscribers. This is a forecast from JP Morgan. They feel like at the end of this year, they will have 99 million paying subscribers. And to put that in context, that will be very close to what Netflix has in global paying subscribers by the end of this year. So an absolutely huge, massive business. Granted, they don't charge as much as Netflix does, but nevertheless, this is very fast, interesting business. On the right side, this shows how many monthly active users ITE has. 434 million. I mean, that's larger than the population of the United States. I mean, it's a massive platform. Users grew by 58% last year. And this part of the business is essentially funded similar to YouTube. So it's mainly funded by ads that people have to watch in order to watch the online video. So again, it's not profitable right now. JP Morgan thinks that out of the large players, they're going to be the first to be, break even next year. And this is a very valuable property that's hidden within Baidu. Another emerging moat is their ownership of Ctrip. This is, again, China's leading online travel agency. This company controls 70% of China's online market, growing extremely fast. Last year, in 2015, Baidu swapped their stake in a company called Qunar for a minority stake in Ctrip, and they currently own about 20% of this company. So, the current value of their Ctrip stake is about close to $6 billion. They put in less than 500 million into Qunar and Ctrip to get that stake, and this is a fantastic return off their initial capital. One bit that part of their business that is experiencing some issues is transaction services. So online to offline. This is a very large business, but it hasn't been profitable. And Baidu has essentially come to the conclusion that there is probably not going to be a path for many bits in this segment to become profitable. They are going to fold this division into their core business starting next quarter. And they've also said that they're going to significantly reduce, scale back spending in order to get closer to break even. They also have a takeout restaurant delivery business that they feel that they've got a pathway to profitability. And if it doesn't get there, it could be a case like Qunar that they basically JV or merge it with another business and get a partial stake in a larger business. So a lot of these businesses are kind of up in the air. Certainly Baidu Maps, very core to their underlying search business. Baidu Cloud, that's very core to their business. But there's some bits that still have a cloud covering the stock right now. Now the main reason that, or one of the main reasons that we got interested in this stock is Baidu's presence in artificial intelligence. And they are China's leading company in artificial intelligence. And again, when you think back to that back half of the chessboard story and digitization, how a huge early impact it's had on so many legacy companies, the artificial intelligence will just take that to a complete new level. And we just think that this is a very interesting opportunity to surf on one of the leaders of China for multi-years with a really long runway. So when we think about moats, emerging moats, what they really are is they're unfair advantages. They're things that your competitors don't have. And there's probably three core AI gating factors that are really, really important to figure out who's likely to win. And the first one is, whoever has the most data and high performance computing wins. So the reality is that the large, huge data sets are already in the hands of a relatively small global handful. Baidu itself has trillions of pages of data, tens of billions of search data, images, positioning data. This is massive amount of very interesting data that's hard to replicate. They also have, one of the largest GPU clusters, so high performance computing in China, if not the largest. And there's a chart here that explains the rise of deep learning or AI. And what happened was that companies were collecting more and more data, but until you had the computing power, the performance, adding more data didn't necessarily add more performance. You can see the traditional learning algo kind of flatlined if computing performance didn't increase. And what we've had recently is this revolution in computing that allowed you to extract more and more value out of your data. And this has been a big game changer over the last couple of years, and is finally set to release kind of the promise of AI that people have been talking about for a long period of time. The next gating factor is talent. You can have data, you can have computing power, but if you don't have algorithms and insight into how to create business opportunities, it's kind of lost. And the good news is that Baidu has one of the largest and deepest R&D AI teams in the world. As far as talent goes, China is #1 in STEM grads, so science, technology, engineering, and mathematics. In fact, they grad more STEM grads than the next 5 countries combined. So just a massive amount of talent that's coming out of Chinese universities. A few years ago, they also passed the United States in academic AI papers, so they are really taking the lead on AI. And as luck would have it, with Trump in power now, suddenly if you're a talented AI engineer, U.S. suddenly doesn't look so favorable, and you might not be able to go there anyway because of the immigration policies. So again, it looks like the competitive field is shifting in favor of China. I mentioned earlier that top-down support is really, really important in China. Earlier this year, the Chinese government picked Baidu to lead their national AI efforts. They didn't pick Alibaba, they didn't pick Tencent, they didn't pick anybody else. So this is a huge validation of Baidu's prowess in AI. And it's hard to quantify exactly, what this means, but certainly there's going to be thousands upon thousands of Chinese, academics and working in universities, working shoulder to shoulder with Baidu on AI. The Chinese government's going to provide a lot of funding, a lot of sort of special permissions that are required to get things done. So when you think about entire nation supporting you and Baidu's own talent, this is simply a huge unfair advantage that Baidu has versus anybody else, in our opinion. One of the first areas that is benefiting from AI is the traditional search business. So, already we're seeing it, certainly myself, if I can avoid, typing in text and just talking, it's far more efficient. I mean, speech is more efficient than typing. Taking a picture and having the ability to process that image and get something intelligent, it's basically a game changer when you think about, today's world where everybody's got their heads down, looking at their small, tiny keyboard and typing into a small, tiny handset. So, as this happens, there's going to be more and more data, and the underlying platform that Baidu is developing is going to bring a lot of value to Baidu. So just a couple other examples of optionality. I talked about conversational computing. So you're not just talking to your phone. You might be at your home. You might be in your car. But again, this is very much a game changer technology. Baidu is going to combine their cloud with AI. So that's going to be very important going into the future, is to combine those technologies. Autonomous driving. We've heard a lot about certainly North America autonomous driving, but in China, Baidu is one of the ones leading the efforts. And another big area they're looking at right now is combining AI with fintech. So, recently they just announced an agreement with the Agricultural Bank of China. There's a lot of opportunities, and it's a huge underlying business opportunity for Baidu. I mentioned earlier that there's essentially a handful of giants that have a lot of advantages. They've sometimes been referred to as the Super 7, the hyperscale Super 7s. And if you look at the market cap of this, Super 7, Google being the largest market cap out of the Super 7, 670 billion or so, they're all a magnitude greater than Baidu. In fact, they're 5 to 10 times larger than Baidu. So, when you're thinking about compounding an opportunity set and companies that are overlooked, certainly it's easier to compound value from a small starting base than from a large starting base. On the right, you can see what the stock price of each one of those Super 7 has done versus revenue. And for the most part, the stocks have outperformed, certainly from a revenue perspective, the underlying business. Of course, Baidu has had great revenue growth, but it hasn't been profitable, as I've mentioned. They had the search issues. They're growing these unprofitable businesses today. But as this kind of shifts in the next couple of years, we think that there's a huge pent-up potential in Baidu to potentially have explosive growth going forward. We try to think about companies, with a margin of safety, and what is this underlying business worth, the core search business they currently have. So maybe one way to think about it is, Google, before they started to diversify with these other bets, in really tough, pessimistic times, how low did the pure search business trade for Google? And the answer is, at the bottom of the Great Recession, essentially it traded at just shy of 12 times pre-tax profits. So keeping that in mind when we think about Baidu, which has also a fantastic search business. So this is a sort of the sum of the parts valuation, a low and high. Kind of think about Baidu first, what do we have now? What is sort of the downside? And so out of the pieces I talked about, I mean, C-Trip is simply the market cap of, C-Trip today versus and how much they own. There's cash. ITE, that's essentially a low bid takeout valuation they received mid-2016. Other investments, again, this is a huge haircut on what they paid currently. So if you take a very pessimistic view of their non-core assets, you see that essentially the search is being priced at about 12 times pre-tax earnings today. So again, that's very close to Google's bottom. Another way to look at it is, if you paid 15 times the search business, you get everything else for Baidu for free. And Google, for most of its history, has traded well above 15 times for the search business. So a couple of different ways of looking at it. Kind of looking more to the future, what will they do with it? Certainly Baidu is China's AI leader. If you look at value creation over time in the computing world, it tends to go, most of the spoils go to the top computing leaders. So this is a chart that Morgan Stanley did a few years ago that showed, different eras in the market cap of the top 5 computing leaders. You had the mainframe era, mini computer, PC, desktop internet, and of course this is a logarithmic chart. Today, if you kind of think about today's computing leaders and the mobile internet, you take the top 5, it's close to a $3 trillion market cap of the winners today. And again, if you think back to the quote from Robin Lee that, internet is, just the appetizer and AI is the entree, and if this pattern continues, you can, use your imagination of how much value the top players might have. And again, the starting base of Baidu is very modest at $62 billion, really with no optionality at all for AI today. So that's just upside. Of course, no business is without risk. We kind of think about risk kind of in a bucket of 3, the trinity of risk. Balance sheet risk, we think, is low, lots of cash, liquid securities. Valuation of risk is low, just went over that. Business risk, I mean, there is China risk. Obviously fast-moving technology is disruptive, but there's a bunch of moat businesses that we think offset some of those risks. So we're comfortable with the risk profile for Baidu. So just to summarize, huge opportunity in China, founder-led, huge moat in search, lots of optionality in non-search businesses as well. The potential to surf from another wave that we think is going to be very interesting, certainly in our lifetimes here, and then available at a very reasonable price. So that's the summary of Baidu. Now I'll let Dave talk about MatterSight.
Thanks, Felix. Yeah, before I get into my idea in particular, I think when we look at artificial intelligence, we see kind of a barbell approach, and the one area we see the opportunity for companies to really dominate and create big barriers is on the platform companies. And this is, in North America, you think Google, Facebook, Amazon, China, Baidu, the idea that Felix just mentioned. But I mean, these platform companies have massive data sets, they have huge talent bases, and they have high performance computing power. So really trying to compete with those companies is a big challenge. Where I look more small cap companies, so where we see opportunities are in what we call point solutions. And these are companies that have built up niche proprietary data sets. You have very focused teams who understand the industry and their customers extremely well, and they get up every day trying to deliver ROI to their customers. And specifically for us, we've spent a lot of time investing in technology, and we, aside from AI, I mean, when we're looking at software companies, we're always trying to find businesses that provide a solution to businesses. Consumers may buy cool technology and things that look really awesome and are trendy. Businesses, they either want to increase revenue or they want to decrease costs. Either way, what they want to be able to do is increase their cash flow from any solution they may purchase. So that brings us to our idea of MatterSight. Stock has not performed well lately. That's usually when you see us getting excited about things. In brief, company is a niche business. It was spun out of a previous business called eLoyalty effectively in 2011. They got a blue chip client base, and this is a high recurring software business. Our thesis, we in the small cap world, what we're always trying to do is find emerging leaders in niche businesses, and generally with having a big runway ahead of them, because when we're right, we can be there for a while and we can just let the business take care of our return for us. The MatterSight has high insider ownership. It has this massive data set, which is a valuable intangible asset. They have, I'll get into it a bit more, but the key point is they have about 1.5 billion phone calls logged in their database, and they have about 140 million phone numbers associated with those phone calls. And we think where it's trading at today is quite a reasonable valuation. The business is, this is call center enterprise software. In its simplest form, MatterSight solutions center around automatically determining a customer's personality type through conversation. And with this, what the objectives are to reduce call times when people call into call centers. It's to increase sales conversions when people call in. It's to help predict outcomes and train staff. The history of the company, as I mentioned earlier, this company sprung out of this company called eLoyalty, which was a consulting business, and working with a bunch of these call centers, they were able to build up this data set over a long period of time. And then they were able to start providing great ROI metrics for their clients. And the company got to a point where they had such great organic traction from this business line that they actually sold off the whole eLoyalty business. And with the strategic focus moving, they really are a pioneer in behavioral science-based call routing. And speaking to management, the CEO has been selling solutions in the call center environment for over, since the early 90s. COO has been there since the early 2000s. So, this is the management team who has been in this industry trying to deliver ROI and figure it out for a long time. This is consistent with a lot of our investments, where we'll see a company and they work in a particular industry for a long period of time, and finally, 10 years later, they figure out the right product or solution, and it becomes one of those 15-year overnight success stories. And we follow a lot of these companies, waiting for them to hit these types of inflection points. One of the problems in this industry today is the death of brick and mortar. With the death of brick and mortar, what we're seeing is a decrease in call volumes, but because of all the digital self-service available. But what we're seeing is an increase in complexity of calls. So when people call in, it's not for a simple solution. It tends to be fairly complicated, and that increases the need for positive outcomes of each call. The solution that MatterSight's developed, as a client with customer behavioral data, you can drive better outcomes. You can routing the call to the agent who matches the customer's personality type. So when you call into a call center, having someone on the other side of the line who can serve you better, it will reduce your call times. It increases sales conversions, increasing the company's net promoter score. You can also then train staff on how to deal with different personality types, and you can create robust analytics based on your customer's personality type and their interaction with your business. The emerging moat that we see with MatterSight is very much first mover advantage. They're a pioneer in applying behavioral science through machine learning, artificial intelligence in call center environments. They're able to do that because they have the calls there and they have the people on board. We see this as a secular trend. I mean, we think MatterSight is currently surfing two waves. The artificial intelligence, the trend of its own. We also think that behavioral science, empowering behavioral science to yield tangible results for businesses is a trend on its own, and I think this is one of the things that we'll see emerging in AI over the next decade. Additional emerging parts of the emerging moat. I mentioned the large proprietary niche data set. There's a natural feedback loop, and they have subject expertise. I'll go into a couple of these here. The natural feedback loop. So, over 1 billion calls recorded today. The company's history is crucial in this respect. The consulting business allowed them to collect all these recorded calls. So this is, it's hard for a pure play tech company to just walk in and replicate this database. And this represents over 150 million hours of phone calls. But behavioral science is really the center of the solution and the true secret sauce for the company. The personality types of people calling in and the phone number it's associated with, they're able to match people based on tone, tempo, syntax, and grammar. And once this used to be well, you think it used to be fairly an intangible benefit to drive, but with the artificial intelligence that MatterSight's applying to these phone calls, it's actually driving tangible, replicable, and robust results. On the machine learning side, this just strengthens the solution and increases usage. But it's very much about the team. And MatterSight today has over 50 scientists, 6 are PhD level. They're focused on behavioral science or machine learning. I mean, this is pretty impressive for a sub $100 million market cap company. I mean, to just go out and hire this many highly skilled professionals in these two areas, which are in high demand right now, I mean, you could probably get some takeout values just for people looking for the skill set today. What do the machine learning scientists do? They analyze the calls, and then they're continually optimizing algorithms to make outcomes for all these calls a lot more predictable. And as a result of all this, the moat just keeps on getting deeper. As more calls are recorded, the data set grows, and it becomes harder to replicate. And then algorithms also automatically improve, which increases the power of the solution. So the more people using the algorithm, the better the ROI becomes. We're always trying to find these companies early on with large addressable markets. The business today is solely the enterprise call center environment. It's a $6 billion opportunity today, but there's other verticals, other markets that this company is moving into if you look at their product roadmap and talk to management. But really, currently they're a $50 million business addressing a $6 billion market, so definitely early innings. The client base, very much blue chip customer base today. I think what's interesting, you'll see there is a lot of kind of healthcare and retail represented here, and this actually introduces some seasonality into the company, which I think is probably misunderstood. When people are looking for SaaS businesses and recurring revenue, seasonality is quite often misunderstood. With these two verticals, in the healthcare sector, Q4 is always the busiest time of year in the healthcare sector, so call center staff up. So even though a healthcare organization may have a contract with MatterSight for a minimum number of seats, they will scale that up in their busy season and take on more licenses during peak demand periods. And then so obviously that falls off in Q1, Q2. So really positive impact on Q3 and Q4. And then on the retail side, most retailers aren't implementing new technology around Thanksgiving and Christmas time. So there really is a rush to adopt solutions like this in Q1, Q2, which translates into billings and revenue recognition going into Q3 and the early parts of Q4. Company has had exceptional growth over the past few quarters. This doesn't actually, this is sales of their routing product, so it doesn't represent revenue, but we look at the active PBR seats as an indicator of health of the business and growth of the business. Stepping back to kind of look at the technology moats and the development of these emerging moats in AI today. If we look at the 1990s, moats were all about the systems of record. So those businesses that digitize paper processes or keep record of inventory, etc. Think of SAP and Oracle. Moving forward into the 2000s, we think the moats were the systems of engagement, WeChat and Facebook, technology that helps engage or converse. Facebook's become a conversational tool for business to connect with customers. WeChat's the largest platform in China for engagement. We use Slack in our workplace, another wonderful communications tool. Going forward, we think this is going to transition to systems of intelligence. And this is basically an integration of the two above systems, where you've got the customer data systems or the systems of record, and you got the systems of engagement. And the systems of intelligence can then empower better outcomes and better decisions for customers. The competition, I think the traditional call center solution providers would be the traditional competitors here. But I think what differentiates MatterSight today is their focus on behavioral science versus call center optimization, where the majority of these other people play. The quick financial summary of the company. Revenue last year was $43 million. Growth rate's been about 18% annualized over the last 2 years. Really nice 60% gross margins. The operating cash burn is decelerating. Currently, it's about $8 million a year. This is where we find a lot of our best ideas, where we see the trajectory through to cash flow break even and profitability based on our understanding of the op costs in technology businesses, because we see usually a re-rating in the stock when a company goes from, is it burning too much money and can it get to profitability? As soon as we start to see that, then we get a normalized market multiple for the company. And we think EBITDA break even by the end of the year, cash flow break even year after is very achievable for the company. Speaking of valuation, currently trades at 2.3 times revenue. We use revenue on these subscale businesses. Cash flow tends to be meaningless since it's usually negative. But if you understand the margin potential and structure of the business, you can use revenue as a proxy for cash flow when the company gets through to scale. Private market valuation for a company of this nature, we think in a normal market is 3 to 5 times revenue. We have seen some really aggressive buying in of companies by both strategic and private equity firms lately. So getting in the 8 to 10 times revenue is not out of the ballpark. But we like to, we think in a normalized environment, 3 to 5 times revenue based on margin profile. Anybody who wants to buy a business for business reasons, that's what they'll pay at least. So big margin of safety in this stock today. We expect the company to refinance debt in the near term, so that could be upcoming catalyst for the business. So in summary, the emerging moat company, it's riding some secular trends. An aligned management team owns about 17% of the stock, as well as being very experienced and knows this industry and customer base extremely well. It's a niche solution, and it delivers a tangible ROI. I can't stress that enough. If you're providing real value to your customers, people are going to buy your product. And we think this is near an inflection point, both in terms of flipping the corner into cash flow positive territory, as well as refinancing of debt. And based on where it's at today, we think this is cheap in multiple takeout scenarios, either from a competitive standpoint, a strategic wanting to move into the space, or even on a talent acquisition scenario. So with that, I think John, we can open it up to any questions anyone may have on Baidu or MatterSight.
Great. Well, thank you so much, Dave and Felix, for the two ideas and for articulating them so clearly. A reminder to everyone listening, if you have a question, feel free to type it into the online interface. Maybe, Dave, we'll start with MatterSight, as there are fewer questions on that, and then we'll move to Baidu. On MatterSight, a questioner basically trying to understand it a little bit better says, trying to understand the revenue declines and the losses over 10 years. At what point did MatterSight transition from consulting to data sales? And can you elaborate a little bit more on the revenue model? You said it's recurring. Could you expand on that? Does the company have long-term contracts?
Yeah. So the business transition occurred in 2011. So that was prior to that, you would a lot of the revenue would be consulting in nature. So looking at the data side of the business, you really have to start in 2011. When we look at the customer base, most of their customers sign 3 to 5 year contracts, and they pay on a per seat basis. And most of these deals on a per seat basis have a seat minimum. And so kind of going back to the healthcare example, one of these healthcare organizations will have 500 seat minimum, for example, and they pay whatever their annual rate is, but they have the ability to scale up above that, and if they go below it, they still have to pay. And so what that ends up doing is it introduces revenue bumps in the back half of the year because of the seasonality of the healthcare business.
And Dave, a question on the revenue. It's quite small at this point, reflects the niche nature of the business. But how do you think about the total addressable market and kind of the size that this company could grow into?
Yeah, it's a $6 billion market. When we look at size, this is still early innings. So you don't have mass market adoption. That will take a while. But if these markets get to kind of 50% penetration, that's a wonderful thing. I mean, what we look at is how compelling the ROI is on the product, where it's basically a 6-month payback for anybody who adopts this solution. When you take into account the cost savings from reduced call times, but also the ROI becomes even better if you start factoring in some of the upsell data we've seen, particularly in the telecom and cableco segments of their business.
Great. Well, in the interest of time, I'm going to switch to Baidu now. And the first question, why invest in Baidu over Google in a scenario where the Chinese government lets Google and Facebook in? Does that change your thesis, or is Baidu too deeply embedded at this point?
Well, I think that's a good question. Of course, that's always possible. The Chinese government has made AI in particular a very strategic, important goal for the government. So given how impactful AI is going to have for society, I would be very surprised if they wanted to level the field and not have a national champion. But that being said, anything's possible. We've certainly seen crazier things happen in the past. One of the things that Google coming in is that they simply don't have a decade's worth of search data and specific to the Chinese market, and that's really important. It's the data that's important, and so without all that data, you really can't optimize your algorithms. So even if they do come in, which I think is unlikely because of the first reason, the second reason, I do think that they do have a deep moat. I mean, even going back when Microsoft tried to crack Google with Bing, I mean, they put all kinds of resources behind Bing. And simply put, they didn't have the data in order to compete. So it really is a scale game, and Baidu has scale in China, which Google, unless they have a time machine, aren't going to be able to get.
A related question, is Netflix also restricted in terms of expanding into China?
Yes, it is. In fact, last month, or maybe it was 2 months ago, ITE signed an agreement with Netflix to show Netflix content on their platform. So Netflix recognized that they couldn't break into China for the same blocking and tackling reasons that the Chinese government wants to champion their own champions. So they decided to partner with the leading Chinese online video platform, which is iQIYI. So essentially, if you want all those proprietary content that Netflix is producing in China, you're only going to get it through Baidu's platform. So again, unlikely that that's going to change, and for the time being, that's an additional tailwind that will get more subscribers to come to iQIYI if they want to see all, all these new shows that that Netflix is doing that are actually quite popular, and for a long time were being downloaded illegally in China. Well, that is, that has changed recently with all these platforms.
There's a question related to WeChat, which appears to be challenging Baidu. It seems to be a move to more of a closed web in China, and whether that's an issue for Baidu. WeChat might be implementing search functionality as well.
Yeah, well, certainly Tencent and WeChat, I mean, they're a formidable competitor, and it's reflected in the market cap differences between the two companies. So they've certainly had a huge tailwind, and you're absolutely right. So they're trying to incorporate more and more into this sort of walled garden or closed system with WeChat, and that is the largest platform. A couple of things on that. One, as far as time spent on the web, the iQIYI platform, the video platform I was talking about, it has the second most amount of user time in China after WeChat. So Baidu itself does have a very interesting platform as far as where people spend their time. And then secondly, I talked about this conversational computing paradigm. So if you take a look at where a lot of value was being created in different computing cycles, one of the first paradigm shift is, why did PCs take off? Well, because you had basically the mouse, and that made it far more accessible to more people once you had the mouse. Then you had the touch interface, so suddenly everything changed. Once this new interface came through, the competitive, the basic competition changed, and people that did touch really well and optimized their products for touch did well. Well, when you think about interfaces, what's the most natural interface in the world? Well, it's just speech, talking. I mean, this is the stuff we did. We're not naturally walking around everywhere with our heads down, looking at small, tiny screens. So, if the basis of competition maybe changes away from screens, and people are, ordering things at home or in their car, that might take away some of the attention from WeChat. But there's no question that WeChat is a huge platform. And one of the reasons why the market cap differences are different is that WeChat has been winning in this current cycle, relatively speaking. But there's still a place for search, even if it's not as large as WeChat, in our opinion.
Can you comment on what appears to be quite a lot of turnover in the leadership of Baidu? What's driving that, and are you concerned about it?
Well, that's certainly a concern. I think one of the things that happens is when you're kind of trailing, there's sort of a halo effect that happens. So, if you actually looked at some of the turnover that's happened in Google's, especially in their quote-unquote other divisions bet, there's been quite a bit of turnover there as well. I mean, in Tesla, but people kind of notice it more in Baidu because, the narrative isn't terrific. So, and the other thing is that I kind of mentioned earlier is that they are shifting business models. So, a couple of years ago they thought this O2O, online to offline division would be huge, and it actually is a very huge division, but it's not profitable. So a lot of the leaders that were leading those divisions, they're shifting strategies. So so that's just part of it, is that they're shifting strategies. I think turnover is kind of natural, and there's so much opportunity in AI, and people are dangling big money for competitors. But at the same time, I mean, there was just actually an article, I think, the other day, a couple of days ago, by Forbes magazine, of the top 28 leaders in China for AI, and I forget the count, but Baidu was completely overrepresented on that list. They have way more AI, top-level senior AI talent than anybody else, and so we're not overly worried, given the kind of dynamics that are happening internally, kind of the natural thing that happens for any leading organization. They're going to get poached for the top talent, and the fact that they still seem to have a pretty deep bench right now. And not only that, as I mentioned, the Chinese government is backing Baidu. So, you have, on a look-through basis, Buffett often talks about, businesses on a look-through basis. Well, on an R&D and pure amount of resources, whether it's headcount and talent and funding and all that kind of stuff. I mean, Baidu has backing of the Chinese government in an area that Chinese government considers extremely strategic. So I think that they're going to get more than their fair share of talent for a long time.
There's a perception that Chinese don't pay for movies. They want to watch everything for free. How do you think that affects the monetization opportunity of IQE?
Yeah, well, that's certainly true, a couple of years ago. In fact, it was somewhat true before Netflix arrived on the scene, here in North America as well. But in the last couple of years, there's been, a big crackdown in China of, piracy. And part of it is because, suddenly Chinese companies were producing their own content and suddenly it was impacting themselves. So if you take a look, again, if you look at that ramp of subscriber growth and legally paying for content, I think that was true, that sort of perception, that narrative like 2 or 3 years ago, but it is changing quite a bit. And again, even if you subscribe to ITE, the monthly subscription cost is something like, $2 a month versus whatever, $9 or $10 for Netflix. So it's not a massive cost, and you can avoid a lot of, competition. You avoid scrutiny from the government. So, it is in the midst of shifting right now, and I think a lot of people still think of China like it was a couple of years ago. So again, I think that's another opportunity of where people are kind of using old facts to view these things, where the facts on the ground are changing rapidly today.
Is Baidu only a China play? What about the rest of Asia?
Well, that's interesting you should say that. Currently today, it is mainly a China play, but certainly aspirationally, they have aspirations far larger than China. When you look at their, autonomous driving, for example, or cloud computing and all these, new AI-driven technologies, they're applicable far beyond the Chinese borders. So, it does tend to be sort of these, winner take all, winner take most dynamics, and certainly, the Asian giants are very favorably positioned, obviously in China, but also in at least the balance of Asia. And aspirationally, like today, Baidu is, partnering up with, a lot of the top, auto suppliers in Europe to push their autonomous driving efforts. So whether they succeed or not, again, I think a lot of that's just optionality. There's plenty of opportunity already in China, but if they succeed, absolutely, a lot of this technology is applicable globally.
We are almost out of time, so I'd like to just take one last question, and actually this one is on an idea you guys have presented in the past, whether you would give a quick update on Onyx. Yes,
yeah, Onyx is an idea we presented last year. I think it's up something like 31% from when we presented it, at least in Canadian dollars. It's a Canadian company. So yeah, that's one of these long-term compounders that we feel, quite comfortable owning. I showed earlier how Baidu has underperformed the underlying business, we believe, with lots of pent-up potential. We think Onyx is a terrific business, but frankly speaking, its stock has probably outperformed the underlying business. So, sometimes you need a while to sort of, back in the fundamentals. It doesn't mean that you blow it out. We certainly are still bullish, but it's not as attractive as it was last year. But when you find compounders that have long runways for multiple years, we're really reluctant to give up on those, if they're slightly, overvalued. And I think that's a mistake that a lot of investors do, is they interrupt the compounding process way too early. They get impatient or what have you. So, we really like Onyx. It's got one of the best, in our opinion, incentive, aligned management teams out of almost any company that we see. And the underlying, tailwind into alternate assets and their ability to perform is is something that we want to be part of for many years. So really happy with the performance of last year. Love the company. The price isn't as attractive as last year, but it's certainly not a sell at this price.
Well, on that note, we will end today's session. Dave and Felix, thank you so very much once again for being with us today and for sharing two very, very interesting ideas and for explaining why you believe they offer attractive risk rewards.
Great. Thanks for having us, John.
Always a pleasure.
Thanks,
and to those of you participating, thanks for being with us. This does conclude the live portion of Wide-Moat Investing Summit. Just a reminder that we have numerous sessions available for replay in the online conference area, and I encourage you to take a look there. We also will have a replay of this live session available as early as tomorrow morning. I look forward to having you with us on another occasion. For now, goodbye.